In this presentation, I am going to cover the in-depth concept of delta neutral strategy. So, what is a delta neutral strategy? Why we are going to form a delta neutral strategy? All these things I am going to discuss during this presentation. So, delta neutral strategy with specific market anticipation, specific trend anticipation, we need to design for a profitable trade. Before going to this particular session, before starting the subject discussions, let me show you specific trade contract notes which I have taken personally from the period of 8th August to 14th August. So this is my trade contract note for 8th August to 14th August. So I'll be just going to that particular trade contract notes. So here I'm going to highlight the specific trades. So this was a trade being taken on 8th of August, and this is being documented here. So this is my personal trade contract note, and you will be finding out the date, my name, and all other informations here. So time of that trade also is being mentioned here. So I have just entered a trade in the Bank Nifty around 9:21, and my trade was I sold a Bank Nifty future at 14,805, and simultaneously I am buying 15,000 call option 6 lots, and this is with an average price of almost 200. So this is what my strategy for Bank Nifty at 8th August. So same trade, I have just done a speculation here on 14th August. So this is the 13th August. So 13th August I just did a oscillation in this particular trade. 13th August I'm going to close this trade at a price of, when the Bank Nifty has touched a level of 15,070, that particular time I closed the future. I took some losses here, and the 15,000 call option which I have bought 150 quantity is being squared off at a price of 261.20. Again, after a specific period of time, I am getting 1 o'clock 3 minutes. Again I got a chance when the Bank Nifty fallen down to 14,925. Again I am entering the same trade, and at a 202 rupees or 202 rupees average. So here I am making a profit of some 8,600 in the Bank Nifty options. Simultaneously, I'll be also losing some amount on the futures. So the net profit and loss analysis, I'll be showing it in my Excel sheet presentation. So same day on the 13th, similar kind of one trade I am just entering in the Nifty. I am buying the Nifty at 7768, and simultaneously I am buying put option of 7,700 at 51, that to 6 lots to neutralize the delta, and the same trade I am closing here when the Nifty comes to 7715, and I am closing the option at 73 and future at 7715. Again I re-entered the trade when the Nifty from 7715 it has bounced back to 7757. That time again I am re-entering this particular trade with the options at 53.20. So this is what I did in this particular trade. And the profit and loss objective I will be showing here. The 8th August trade which I have taken and closed on 13th August with Bank Nifty at 14,805, 15,000 call option average price 200, closed at 15,070 and 261, made a profit of 2,525. For Nifty, 13th August, the trade which I have entered, and 73.35 when I closed it and come out with the 7715 level of Nifty, it gives me 9,270 profit. Again re-enter of that Bank Nifty, which is on the 13th August, again re-entered at 14,925 and 203 as the price. That same trade I have closed today, which is on the 14th of August, and 14th of August. So here is the trade I have closed it, 15,049. So 15,049.90, 15,050 I am closing the Bank Nifty, and simultaneously I am closing the 15,000 call also with an average price of 240. So 240 here, average price of 240. So this too also gives me a profit of around 2,450. In fact, the carry forward trade of the Nifty, which has been initiated second time is at a loss because I have re-entered at 53. Currently it is quoting at 41. So 12 rupees. I am just losing in that particular option, and I am making some profit in the future, which I have entered at 7757 level. So this is how the trades I have taken. So this is how the net profit is being earned, and this trade, 2 days of trade, has given me roughly 14,000 profit, and one trade is still pending. It is at a small loss of 2,000 plus. So how this trade is being initiated, what is the basis of this trade, why this trade is being taken, so that thing I am going to describe in my theoretical presentation. So here, delta neutral strategy you can initiate in 3 different ways. One, by keeping the delta as 0. Second, you can keep the net delta as positive or net delta as negative. So delta neutral doesn't mean that always the delta has to be 0. So what is a delta? What is the definition of this delta? Delta says that for each 1% change in the underlying asset price, how much change one particular strike option can give you. Assume the delta of 7,700 put option is 0.24 negative. So 0.24 negative, if this is the delta of a put option, this says that for each 1% changes will trigger in the downside in the Nifty, we can expect 24% of changes in the delta terms or in the premium terms, and that too on the time value component. So to more specific to this, if I am saying that 7,700 put option, what you have seen just now, is 41, and Nifty is trading at 7783 level currently. This is future. So if I will say the 7th, and it is having a delta of 0.24 negative, then I will say if 1% fall in the Nifty from here, so which is almost 77 points of a fall in the Nifty, if the Nifty fall down to 77 point, so which is coming means 6 as 13 and here 77 as 0. If it Nifty falling down to 7706, then my put option 41 which I have taken, this will increase by 24%. So 41 into 24%, which is coming to 9 rupees 84 paisa. So my price will be 41 plus 9, so 50 rupees and 84 paisa. This option will be trading, provided the implied volatility and volatility of this particular instrument remains same and it doesn't changes. Means if the IV of the option is currently 10% and the volatility of the future is currently 16% per annum, and if this fall happens without the change in the volatility, without the change in the IV, then your option will be at 51 rupees. If the IV increases or the volatility increases, then this option which you have estimated at 50 rupees 84 paisa may be trading higher than 50 rupees 84 paisa. Same condition holds good if the IV falls down and the volatility also falls down. With the price fall, then you may not get 50 rupees, you may be getting lesser. So this is with respect to the incremental cycle of the put option. Same argument holds good for the decremental cycle of the put option. That means from 7783, if Nifty goes up by 77 point, so this 41 rupees of the option will decay by 24%. So this tendency of the options which is being monitored in the name of delta is going to help you to form a delta neutral strategy. So as I said to you, delta neutral strategy, whenever you are forming, you can form with a net delta 0, net delta negative or net delta positive. So when to form which kind of net delta positive, negative and 0 strategy? So keeping the delta at positive is recommended in a rising market with low volatility condition. That means when any instrument will be having a less than 20% volatility and the price trend will be up, that time forming a net delta positive strategy is recommended. Why? In a rising market with a low volatility, the option will be having a lesser time value component, henceforth any further decay in the volatility is going to impact the IV in a lesser extent. So having a positive delta strategy is well recommended at that particular time. In a negative delta is recommended in a falling market with high volatility. Whenever the prices are falling and you are expecting the volatility to remain high or go further high, that time net delta negative strategy is recommended. And same argument, if you are saying that it is a low volatile market, volatility is low, and simultaneously prices are falling. Normally the volatility and price used to move in two different directions. That means if the volatility is rising, the price has to fall, or the price is falling, then volatility has to rise. Other argument is if the prices are going up, then also the volatility has to fall. So price and volatility has an inverse relationship. So inverse relationship for the price and volatility. So what happened here? This is a precondition, but this condition will hold good always. That is no certainty about that. This is a maximum cases, this kind of conditions you will experience. But certain time what happens? Price used to fall, along with volatility also used to fall. Instead of moving inverse direction, they used to move in a same direction. So prices used to rise and same time the volatility also used to rise. In such kind of situation, when the price is falling and volatility also falling, in that particular situation also forming a net delta negative strategy is beneficial. Instead of waiting for a high volatility condition, if the prices are falling and volatility is falling, in that case also it is advisable to form a net delta negative strategy. If the prices are rising and volatility also rising, forming a net delta positive strategy also being recommended. Then Now coming to to understand the trend of this market. Delta zero strategy is initiated when the market is range bound, when the price finds under resistance and support at a particular band. So how to understand that band? That I will demonstrate in our tool. And whenever this net positive and net negative delta strategy you are forming, that should be more than 3%. That net you have to keep more than 3%. So that strategy will be going for a profitable zone. And this delta is directly linked to our underlying asset price movement. Henceforth, this delta also gives you, delta neutral strategy gives you the profit whenever the prices used to move either in positive or negative direction, or it should move in the anticipated direction of our trade. The strategies, note what I have shown to you. Same positions are being given to you if you, in our Google group, and if you are registered in our website. Same strategies also we have emailed you on 8th, and we also emailed you the profit booking time on 13th, that this strategy has matured. Now you start booking the profit on this particular strategy. So that already we have informed to you, and already you have taken the benefit of this particular strategy. So basis of which this strategy is being formed. So as I told you the last case, wherein I said that it is not always true that price fall with volatility rise or price rise with volatility fall will continue in the market. Sometimes the prices used to fall and the volatility used to also in a falling trend. So same kind of observations we have made in the Nifty. So if you just go to the Nifty price quote, and if you go to the other informations, you will get the informations here that annual volatility is 16%, which is less than 20%, which is a low volatility scenario. So since you are in low, it is very remote possibility you can make further low and low. But the 8th, when we have just given this strategy, when the Nifty was at 7595 level and 7600 call option was giving you one premium of 97. This strategy, when it is being recommended in our Google group, that particular day, that contract note also I am going to show you. So the trade for 8th August. So this is the 8th August trade contract note for note for the Nifty. When the Nifty was at 7593 level and 7600 call option was quoting at a level of 93.3. In that particular time, the volatility of the Nifty was rolling low, having a fall of 1% on the future terms in the same day. So if the volatility could have been higher, then I must have thought it in a different way. So I formed a net positive delta neutral strategy, and my net delta was above 3%. And this same trade is being closed on the 12th of August. 12th of August, the same trade is being closed here when the Nifty was at 7709. So this is a brought forward contract. So this is the trade which is got executed at 7709, and average of 140 rupees. This particular option is being closed, and the day end that particular option was 174 and 7748. So I have not waited for that particular time. I have just closed at a level which is comfortable to me, and that particular trade has given a gain of 8,310 rupees. So same kind of how you can form such kind of strategy. Suppose you are forming this particular strategy, so you need to understand the internals of that particular day. So I have identified that particular action in this ways. Suppose today I am just on 14th when I am recording this event. If I am just loading the informations of Nifty and I'm just going for the Greek scanner. So here input, call and put options, I'm getting the delta, gamma, vega, theta, omega and IV. So different strikes, all these informations I am getting. I am also getting the informations of Nifty, what it is quoting now. So 16.65, and this is the low volatility scenario. And if I can backtrack these things with my backtesting data, if I'll just backtrack from the past 10 days how the volatility is changing. So from there I am just coming to the conclusion that this volatility is almost constant at the level of 15 to 17. This volatility is almost constant with a range of 15 to 17 and maintaining the upward priceness. So at this particular time, it is advisable to form a net delta negative strategy, because in the rising price we must expect the volatility to fall. So volatility should fall with the price rise, but in our case what happens, price is rising, however volatility maintains a flat curve. It is neither falling nor increasing. Its value is very constant within the range of 16.1 to 16.65. This is the range with a very small difference. It is going to consolidate in this band. So prices are rising, volatility is consolidating. So in this particular time and day, if I am going to form a delta neutral strategy, then how I can go about? So my nearest strike is 7,700. I can think of 7,800 also. So 7,700 strike, current price of 38.80 with the delta 0.2617. Delta is 0.2617. So this is the information I have got. Now if I am just going to buy a Nifty one lot and the put option, if I am targeting for 7,700 and I have found out that delta is 0.24. So four lots of put option if I am buying, then it can compensate my future buying, but I need a net delta above 3% and I need a net delta should be above 3% negative, -3. So herein, if I'll just go for the buying of this put option, say 10 lots, and I'm going to hold it for 5 days, and I'll calculate all this profit and loss levels. And if I'll just go for the net Greek analysis here, so this is giving me the net delta of 1.38. That means it is giving me the net delta of 13%, which is not required by me. So I'll just reduce these things and come to this particular level. So here too also my net delta is -9%. So 9% also is acceptable here. So the acceptable range is -3 minimum, and you can go till maximum -10 or +3 minimum, and you can go to maximum +10. So this is within my reach if I am forming this particular strategy. So this is my profit and loss levels are coming. my loss is maximum till I am at 7,900 level. Once I cross 7,900, my losses are going to reduce, and similarly till 7,042 I am not going to make much profit. Once I am slipping below 7,700, I'll be making the profit, and this profit will be a great profit if the Nifty fall down to 7494 level or 7,500 in the coming 5 days period. However, I do not know how the price trend is scaling at this particular time. For that reason, we have given a trend analyzer which takes into confidence all your implied volatility parameter, current volatility parameter, and from there it used to estimate what is the trend for now. So the current cycle which you are going through, it is 7766 to 7837 considering today's price, and beyond that you will be scaling to 7,900, and beyond that you may go to 7,979. If all 3 cycles is going to complete during this remaining part of the settlement cycle, I'll be having, and if it is going to 7,979 level, I'll be having a loss of 5,252 at this particular trade. And if this cycle breaks below 7,766, my downward cycle will start, and it can bring me to 7,743 level. And in fact, it has the tendency to bring me to 7,720 level. Below that, I'll start making profit, and my profit will be around 5,000 rupees when I will come to 7,674 level. It is monthly cycle. Weekly cycle also says 7,872, 7,776 is the first cycle consolidation band. Cross over that, it can take me to 7,857, whereas my losses will be incremental. Cross over that, it can take me to 7,900 level. There also my losses will be around 7,500. If it fails, then during this coming one trading week, means 5 trading days, it has all probability to bring the prices to 7,682 or below that. So in that case also my profitability is around 5,000 level. So if I can just take a risk reward analysis here, assume if I am coming back to 7,900 plus and booking the losses, my losses will be 7,000. If I fail, this cycle fails and fall down below 7,000 and coming to 7,659 level, then my profits will be also 7,000 rupees. So I have a risk reward of 1:1, and any fall below 7,650 can increment my profit to a great level. Any rise above 7,920, it is going to reduce my liability to a great level. So this is how we should form delta neutral strategy with anticipation of a market uptrend, downtrend, and market neutral. So currently the prices are moving off and the volatility is low, and it is remaining low with no other reduction. This gives me the suspicion that yes, the price is matured. Maybe from here onwards price is not going to move in a great way. So with that particular anticipation, I have formed this particular strategy for buying 7,700 put option, and with a future purchase, and I am just recommending a 7,700 put option buy 8 lots, so that your net delta should be -9%. So this is how you should form the delta neutral strategy and take the benefit of the delta neutral strategy. Delta neutral strategy doesn't mean that always you have to keep the delta at a 0 level. Keeping the delta at a 0 level only rewards you only rewards you in the time value component. It doesn't rewards you in terms of any intrinsic value addition or intrinsic value subtraction. So keeping a delta, net delta positive rewards you when the prices used to move up and intrinsic addition happen in the underlying asset. Net delta negative rewards you when the prices used to fall and intrinsic value addition happens in the put option. So this is how we should trade in the delta neutral strategy.